All right, another housing market update. Welcome, guys. Today is Thursday, September 24th. We're going to be hitting 3 cities: Seattle. We're going to be hitting San Francisco. A lot of you guys have been asking about SoCal, so I'm going to do a city. I'm going to try and do a California city every week for you guys. And then last but not least, we've got Nashville. Same format. We're going to be doing this for investors and also non-investors. So if you're looking to buy a personal residence of your own, I'm going to try and make it applicable and relatable to everybody in the U.S. And also the question, would I buy right now, yes or no? And I'm going to give each market based on what I'm looking to do, whether I'm looking to invest or buy, an overall grade. So let's go ahead and get started. Let's go with Seattle non-investors. I got my notes here with me. So Seattle non-investors, median home price is at $770,000 according to Redfin and Zillow. That's a 12.4% increase year over year. And by the way, guys, these are August numbers. Obviously, we don't have September's numbers yet because it hasn't been a full month yet. September is not over, but I will in a couple of weeks. 14.1% increase in homes sold year over year. Median days on market, 8 days. That's a 64.4 decrease year over year, meaning that it's 64.4% less than it was last year. My guess is probably would have been around 18, 19 days this time last year. Sales price to list price ratio. This is very important. That's 101.7%. That's a 2.4% increase year over year, meaning that if you listed a house in Seattle for $100,000, which by the way, $100,000 in Seattle, you're talking about a shack. That means that house is going to be most likely, according to the numbers, sold for $101.7 thousand. So $101,700. That's 2.4% increase this time last year. 38.6% of all listed homes sell above listing price. That's a 64.8% increase year over year. Only 19% of homes sold with a drop in the price. That's a 5.1% decrease year over year. And fun fact, Seattle's second highest acceleration of housing market in the US. Most buyers are made up of millennials. You know, when I look at these numbers, I'm not confident, right? So to answer the question, would I buy right now? That's a big no. No! You know, I particularly look at this one right here, right? 64.8% increase in terms of homes selling above its listing price. And not only that, 19%, only 19%. That's a 5.1% decrease in terms of homes that are dropping in price, meaning that houses are getting higher and higher in terms of value and sellers aren't budging. It's total seller's market. Overall grade, C minus. So prices are extremely high, right? My reasoning is prices are extremely high, but the growth seems to be at least sustainable. It's an LA 2.0, right? That's what Seattle is. You know what Seattle is like? Seattle is like the pair of sisters that live in Beverly Hills. The older sister gets a G-Wagon and all of a sudden the younger sister starts complaining. All right, now let's move on to Seattle for investors. 1,496 permits pulled in second quarter of 2020, which you're talking about major pandemic months. If you remember back in March, April, May, June, right? Those were in kind of, we got hit the worst in terms of economics. For multifamily, right? Keep in mind, guys, that's 1,496 permits pulled second quarter of 2020. That's permits for multifamily, commercial development, rehab, or construction only. So I'm not talking about single family houses here. I'm talking about commercial. I'm talking about multifamily because we are talking about investing. So that's 1,556 permits pulled for the same category, same time last year in 2019. So this is what it tells me. It tells me that the commercial market hasn't slowed down much despite scares in commercial mortgage-backed securities and also pandemic causes. The average rent currently in Seattle, and this is for single-family house rent, this is for apartment complex rent, any residential rent, average rent is $2,100. That's a 6% increase year over year. So overall thoughts for investing in Seattle, rent is going up, which is good demand, but supply isn't going down anywhere, nor is it slowing down, and that represents competition. And plus, not only that, but there's a lot of potential dangers in investing in Seattle, in my opinion. It's very rent strike oriented. They got a country named Chaz. You know, I feel like that's what you name your kid if you grow up in upper middle class America and you're trying to be special, right? Maybe the kid has green hair, you know, maybe experiments with some music. I don't know. But Seattle, I don't like it. Rent strike. Supply isn't going on anywhere. It's very landlord very anti-landlord. You know, very, very tenant friendly, as far as you can go in tenant friendliness. I'm going to say no, right? Just because the continual rent control seems to be getting out of hand. Overall grade for investing, that would be an F minus. All right, now let's move on to San Francisco. Let's first start with the non-investors. Median home price currently at 1.45 million. That's a 2.3% increase year over year. That's a 14% increase in homes sold year over year. Median days on market is 27 days. That's a 12.5% increase year over year. Sale price to list price, 103.6%. That's a 5.2% decrease year over year, which means it was worse last year. And let me tell you about San Fran, right? Typically, a lot of these SoCal or East Coast markets is whenever an economic thing happens nationally, typically they're the first ones to feel it. My opinion, Seattle is going to go through the same thing in about a year or two. You're going to see the same thing happening in Seattle that you did in San Francisco. Sale price to list price, let's go back to that 103.6%, meaning that if you list a house at $100,000, you're going to sell it most likely, based on the numbers, based on the stats, for $103,600 is what you're most likely going to be buying it for. Homes sold above listing price. This is what I found to be fascinating, and this is where I'm going to double down on my statement, where I feel like Seattle's next in terms of this, right, this montage that we're seeing here. So homes sold above listing price, 49.5%. That's half. That means half of the homes that are listed you're going to sell for above its listing price. Wow. And keep in mind, a lot of realtors, brokers, they put the price high anyways to even start, meaning you're going above that. So 26.6% decrease. That's what I found really fascinating, meaning last year it was way worse. It was a lot hotter. 15.8% of homes sold with a price drop. That's a 182.8% increase year over year this time last year. So it tells me that the hot streak in San Francisco is wearing down. I don't think it's still at normal levels, which I don't even know what normal even means in San Francisco with the type of culture that they have there. But the values are going down and the demand is weakening. So would I buy? That's a big not yet. Maybe, right? If you're in San Francisco and you're a resident, San Franciscoan, I would say not yet. It's one of those situations where you wait 6 months, wait for the supply to kind of be imminent, right? To kind of replenish. With a lot of these forbearances that are going on and delinquency rates that are going on. Overall grade, C. It's kind of like that kid who's super smart but doesn't apply himself until high school or college when it really counts. I'd say, San Francisco is at middle school, right? Give it another couple summers, and you'll actually see that smart kid actually start trying, because that's when it counts. All right, so San Francisco for investors, 851 permits pulled in Q2 of 2020. Again, that's for multifamily and commercial development, rehab, and or construction. 822 permits were pulled for the same category in 2019. So again, not as high as Seattle, which tells me investors are very doubtful. They're very nervous and optimistic, and not as optimistic as they would any other market, which I don't blame them, right? I don't blame them at all. Let's look at August 2020 rental numbers. Average rent for an apartment in San Francisco, California, $3,357, which is it's a 12.81% decrease from last year, which last year, year over year, average rent was $3,787. That tells me a lot of the rent strike, a lot of the rent control thing is kind of taking in place. So again, investors are very nervous, rightfully so. California, especially cities like San Francisco, they're as tenant friendly as you can possibly get, right? I mean, it's California. It's a very blue state. And guys, I'm not getting political. I'm not one way. I'm not the other way. I just like truth. I like facts. What I will say, though, is a lot of the horror stories that I'm hearing about tenants, evictions, failures, right? People not paying rent, people being very difficult, not being very, I guess, reasonable. A lot of those stories are coming from San Francisco. So would I buy? That's a big 아니요. And that, by the way, 아니요 is no in Korean, right? So you learned something in this video. Overall grade, F minus, right? I'm going to give it another F minus. It's kind of like that older sister in Beverly Hills. It's got the G-Wagon. Value is going down. All right, now let's move on to Nashville, other side of the country. For non-investors, median home value, $299,000. That's a 7.1% increase year over year. Median sales price is $346,000. That's a 10.3% increase year over year. 6% year over year increase in amount of closings. That's what I found really fascinating. Not only is the price going up slightly, not too crazy, but the amount of closings that are happening is also increasing. So meaning that you have size, but you also have volume is what you got going on there. Sale price to list price, 98%, meaning that if you put a house on the market listed at 100,000, most likely you're going to sell it statistically for 98,000. Median days on market, 56 days, a little bit more reasonable. I like what I see with Nashville when it comes to non-investing, just buying a personal residence, solid job growth. It's a young town, right? Average age, I believe, is 33, 34. Housing market isn't running away from the consumers like it is a lot of these other markets that I'm looking at for you guys. I don't see it being hit hard. If a downturn were to happen, right, if supply dramatically increases and the consumer strength goes down, I don't see Nashville being hit as hard as cities like Seattle or San Francisco like we just covered. Would I buy? Actually, yes, right? And that doesn't mean I'm moving there, right? Actually, yes.
Yes, you are.
All right, Sam just yelled at me, yes, I am, right? We'll see. All right, overall grade, A-. I think this is my first A. This is my second video of me doing this on a weekly basis. I feel like an Asian parent that never gives out an A, that's never happy with their child. But I'm going to give it an A-, right? Because, due to the national circumstances, that's where the minus comes in. But it's strong, right? It's pretty strong. I'm not going to lie. All right, Nashville for investors. Let's look at it. 981 permits pulled in Q2 of 2020 for multifamily and commercial development, rehab, and construction. Again, same statistic that I pulled for Seattle and San Francisco. 631 permits pulled in Q2. That's a huge difference. That's a 50% increase in 1 year of 2019 for the same category. So it tells me there's huge growth, right? I mean, it doesn't take a rocket scientist to tell you that 981 is a significantly bigger number than 631. By the way, real estate investing, syndication funds, big businesses, REITs, etc., you name it. A lot of them do what's called a feasibility report, meaning that they want to see the numbers, they want to see the population support. Kind of like how Target, if you're going to put a target anywhere, you want to make sure the demographics support the target to make sure that it's making money, right? Big businesses, big real estate funds do that. So there is a reason why these permits are being pulled, because it is mainly commercial permits for these type of assets, not single family houses. Okay, now let's move on to rents. August 2020, average rent is $1,281. Current vacancy rate stands at 94.6%. Both numbers dipped slightly this year. So this is what I think overall for investing in Nashville. So strong supply, one of the lowest unemployment rates pre-pandemic. Had tough times in this year, right, 2020, in terms of growth, but I think everybody could say that. Average age of the resident is 33 years old. It tells me it's a young town. I think they'll bounce back. There's a lot of people in the millennial generation, a lot of young money coming in. I don't think the growth is going to slow down. I don't think it's going to get hit hard as other cities will when it comes to a potential downturn, which I believe is going to happen in 2021. I will do a video, by the way, on that, maybe next Tuesday or the Tuesday after that for the housing market update video. The state is also very, very landlord friendly. It's phenomenal in terms of businesses in regards to taxes. It's amazing. Would I buy? Yes. Obviously, of course, depends on the deal. We got to look at the 10-year market cycle, make sure cash flows in the first 30 days. Got to have good upside with building principal. And I like equity buildup, right? I'm not as big on cash flow as a lot of other investors are. I like the equity accumulation because it's long-term wealth, right? I always say if you want to be rich, go for cash flow. If you want to be wealthy, if you want your family to be wealthy, go for equity. Overall grade, B+. So strength of renters is good. Market and demand could shoot up, yes. Right, I understand that is most likely going to shoot up in terms of strong demand, market, renters, you name it, but unsure how supply will be affected by other investors. Because you got to remember, right, even if the demand is good, if you have too much competition, you're going to get squashed, right? It's not going to be worth it. Income, rent are going to be diluted. So overall grade, B+. I'm loving Nashville, right? And for investing, not moving there, right? I want to preface that. All right, guys, comment down below what 3 cities you want me to cover next. And if there's any way that I can assist you guys and add value to you guys. And of course, guys, I'm going to point out the book, 0 to 75 units in 1 year, literally 291 pages of how I went from 0 to 75 units in 1 year without using any of my own money or credit. It's completely free, right? The link is in the description below, 0 to 75units.com. get the book. It's completely free. All you gotta do is pay $10 for shipping. But comment down below what 3 cities you want me to cover next, what you want me to cover, and I'd be more than happy to read them and do that for you guys. I'll see you guys in the next one. See you next Thursday.